For over a decade, the crypto 4-year cycle was one of the major pattern that every crypto investors and traders will be looking to. Pre-halving accumulation and post-halving parabolic run, and at 80 or more percentage down after that. That pattern was intact for over a decade. But in 2025, that pattern just broken. We are literally more than 21 months after halving right now. Bitcoin is literally 7% down in this year rather than 60% up. The major indicator RSI is never reached 90 plus for a long time. 2024 was the year where Bitcoin reached an all-time high just 1 month before halving. That signaled a broken cycle itself. So one of the major questions in this current situation that most of the every crypto investors are asking is that whether the cycle is already broken. If it is broken, what is the reason for that? So in this video, we are going to tackle that. My name is Saleh. I am into the crypto and Bitcoin space more than 7 years right now. Today we are going to talk about one of the most controversial topic in this crypto market right now. The Bitcoin cycle is broken or not. And what is the reason? Whether the ETFs are the reason or anything else. There are a couple of data that points that Bitcoin is already broken. Bitwise CIO Matt Huguen already confirmed that Bitcoin cycle is already over. And now Arthur Hayes is currently arguing that Bitcoin is currently acting as a proxy of M2 money supply. Even though all these talks and noises will clear out that there are something happened in the cycle. So in this video, we are going to discuss what is 4-year cycle and how that was worked before and what went different in 2024 and 2025. And whether one more thing we are going to tackle here is that whether ETFs are the one of the main reason for this broken cycle. And this video is recording in 2026 January. So if you are watching just before, at least after Q1 of 2026, you need to verify the new data because I am mostly talking on the old data if you are watching after a long time. Everyone knows the Bitcoin is programmed a financial asset. So one of the main interesting fact is that even the supply is also programmed in the Bitcoin script. So the supply is very limited and every 210k block, approximately 4 years, the Bitcoin mining reward will cut in half. So that is called halving. If you look into the halving history, in 2012, first halving occurred. At that time, mining reward was 50 BTC. Then it literally cut to 25 BTC. Next halving was 2016. At that point, mining reward cut from 25 BTC to 12.5 BTC. Next one is 2020. At that point, 12.5 BTC mining reward just halved to 6.25 BTC. And at last in 24, 6.25 BTC to 3.125 BTC. One of the important factor in this halving cycle is that it created something called supply shock. The miners selling pressure will literally cut in half. So in this case, if whether Bitcoin demand is very straight or going up, the price will always goes up. Unless there is something very major issues or something happened in the crypto, that will go downward. Now let's talk about the phases of Bitcoin cycle. There are currently 4 phases. The first one is accumulation phase. This is the point where Bitcoin was literally down more than 70 to 80% from the previous high. This is the point where most of the retail investors will capitulate. But on the other side, the long-term holders will start accumulating. And this is the one of the most boring phases in the Bitcoin market. It will last around 12 to 18 months. You can say that this phase will end just after Bitcoin climb back to the previous peak. Phase 2, pre-halving rally. As halving approaches, one of the main narrative will run in the crypto community is scarcity narrative. The scarcity narrative will pump the Bitcoin further upside. And Bitcoin rallies around 60 to 70% in 6 months before halving. One of the crucial point is that it will not hit the all-time high in this point. It only approaches the previous peak that was down in the last bear market, but it does not break it. Now phase 3, post-halving parabolic run. This is the one of the favorite phase in the Bitcoin cycle. 12 to 18 months after halving, Bitcoin will enter into the parabolic run. It will hit a new all-time high and most of the retails gets FOMOing and buy Bitcoin. This is the point where all the institutions will get interested on the Bitcoin, where the per year return on the Bitcoin will be much more higher compared to all other assets. And RSI will hit 90 plus and it will sustain for a long time. And this phase will last around 12 to 15 months. If you look into the historic peaks in the previous cycles, in 2013, Bitcoin peaked around 11,100 and it's about 12 months post-halving. On 2017, the peak was 20k and it lasted 18 months. In 21, peak was 69k and it will lasted same exact 12 months. Phase 4, crypto winter. This is the saddest phase in the Bitcoin cycle. Bitcoin will literally go down around 70 to 80% after that parabolic run. Tons of liquidations and bankruptcies and everyone declare Bitcoin is dead. But only few long-term investors will sustain this point. You can say this is the one of the best wealth transfer happening in the Bitcoin cycle. And in this point, cycle will reset and long-term buyers will start accumulating. On the summary, this pattern existed for last 3 cycles without any problem. This is the one and only main framework that every crypto investors use during these years. Those investors will accumulate in the accumulation phase and they will take profit after 12 to 18 months halving. Then it will crash. Then the cycle will repeat. But it was only valid till until 2024. Now let's look into what went wrong in 2024 where the cycle just broke. In 2024 to 2025, there are around 5 critical ways that actually changed the cycle. Or you can call it as a difference where there are 5 different happenings where the first difference is Bitcoin peaked before halving. 1 month before halving, on March 14th, Bitcoin peaked around 73k. This was the new all-time high that will broke 2021's 69k peak. This pattern never happened before. In every cycle, the peak only showed up just after 12 to 18 months halving, not before. Maybe the March top will be the starting point that will change all the cycle. So what actually the reason? Is it due to the Bitcoin spot ETF, BlackRock's IBIT, Fidelity's FBTC, 8 other ETFs are just launched in January 11, 2024. They literally accumulated 25 billion in Q1 alone. In these institution demand will just front run the halving. The supply shock just priced in before the halving in this stage. Difference to muted post-halving performance. As of the cycle, we will see a peak just between 12 to 18 months after halving. 2012, 60% in next 12 months. 2016, 122%. 2020 halving, 53%. 2024 halving, -7% within 12 months. Bitcoin was at 94k at the start of 2025. If you look into the 2025 chart, on October, Bitcoin peaked around 125k, then crashed to 87k in late December. So if you look into the time frame of April 2024 to April 2025, the return is minus. The first time in the history, the post-halving year end in negative. Difference 3, RSI never hit that parabolic level. Momentum is actually determined by monthly RSI performance. If the RSI is above 90 plus, that means it's actually in a Eurofic phase or the parabolic run. On 2013, monthly RSI hit 95. 2017 it hit 96, but on 2025 the monthly RSI just only peaked to 68. The 68 is not parabolic, it's a steady control growth. This kind of return is because of the rebalancing of institutional flow, not the retail FOMO entering. Difference 4, volatility collapsed. On 2017, Bitcoin's annualized volatility is more than 100%. You can see approx 20% daily volatility on that time frame. But it comes to 2025, volatility is literally dropped to 43%. Bitcoins literally become less volatile than the high growth stocks, lower than Nvidia stock or lower than high growth tech stocks. Why this is happening? Is it because of the institutions? One of the interesting fact about the ETFs are they rebalance very gradually. They will not panic sell when there is a 10% dip or something. So they created a stabilization flow in the market Before institutions, retail literally making more than 80% of the dips. Currently, we are not seeing that kind of dips. On the summary, you can see that overall volatility is literally reduced because of the institutions. Difference 5. Correlation with traditional market is tightened. Bitcoin used to be uncorrelated to the traditional market and it is considered as a digital gold back in days. But on 2025, Bitcoin's correlation with S&P just hit 0.73. With Nasdaq, it is 0.76. And its correlation with Fed is also increased. On December 10, Fed cut the rate and Bitcoin rallied. On other case, US GDP data delayed, Bitcoin went down. Now in this situation, Bitcoin is a macro asset right now. It is literally moving in the same direction of M2 money supply and central bank policies and all other liquidity functions. Not just like a previous halving cycle, supply and demand correlation. So what changed? The one factor, that is ETF. On January 11, 2024, SEC approved 11 Bitcoin spot ETFs. BlackRock's IBIT, Grayscale's GBTC, Fidelity's FBTC, and ARK's ARKB. This was the revolutionary thing that most of the crypto investors are waiting for last decade. As of December 2025, US Bitcoin ETFs are currently holding around 1.32 million BTC to 1.37 million BTC. That's 6.9% of the total supply, and which is excluding the lost coins, which is around 8 million or something, approx around 8%. BlackRock's IBIT have alone 68 billion in AUM, around 780k BTC. That's literally 60% of all the Bitcoin ETF shares. Even though all the negative returns, the IBIT took in around $27 billion worth of BTC in their ETF. It is now considered as the 6th highest ETF inflow of all the 2025 ETF inflow. Now let's go deeper onto how ETFs are changed in the Bitcoin cycle. 1. Absorbed retail volatility. Let's say there is a sudden move in the market on the downside way, like 20% or something. The retail suddenly started to make the panic selling. But at that point, the institutions will step in and rebalance that position. When Bitcoin dropped from 125k to 90k in late 2025, ETF outflows were $6.3 billion in 1 week. But the net inflow remained unchanged from the start of the ETF launch. It's same as 60 billion. The one of the important correlation you can see is that Bitcoin corrected around 86% in the Q4 of 2025, but ETF holding only declined around 3.6%. The institution don't liquidate on the dips, they literally buy at the point of dip side. This created a floor price that didn't exist in last cycles. 2. Front ran the halving. If you're looking to the historical data, the supply shock will only play out just 12 to 18 months after halving. Retail will only buy when the price started to move. But as ETF launched in January 2024, those people started to accumulating January itself. By April, $50 billion worth of institutional capital just entered into the Bitcoin. So the supply shock was just priced in. This was the reason there is no post-halving peak occurred in the 2024, because the institution already played out the peak in 1 month before halving. 4. Reduced dependency on halving. On 2012, halving reduced miners selling 25 BTC per block. That's around 3,600 BTC per day. That was around 2.5% of the daily volume. So that supply shock is very high at that point. But coming back to 2024, the halving reduced the miners selling 3.125 BTC per block. That's around 450 BTC per day. If you look into the daily volume of the BTC across all the exchanges, spot BTC daily volume is around 500k BTC. So in this case, miners is selling 0.09% of daily volume. That's very minute. On the other hand, daily ETF inflow is around 10k to 20k BTC. So while compared to the ETF inflow, the miners selling BTC is very minute. Arthur Hayes says this is a long live the king thesis. Bitcoin is no longer correlated with the supply shocks of halving. Now it's completely driven by global liquidity, M2 money supply, central bank policy and credit expansion. Now only halving matters for the narratives, not for the mechanics. Now our main question, the cycle is dead or not? The answer is it's not dead, but it's fundamentally weakened right now. Now it is not going to be a fundamental driver of the Bitcoin price action. There are other factors as well. Now we will look into what are the core crypto papers are saying about the cycle. Matt Hugan, Bitwise CIO, he confirms that cycle is already over. He says that 4-year cycle is now overwhelmed right now. Now retail FOMO is replaced by institutional capital. The minor selling pressure is now replaced by ETF flows. The halving supply shock is now replaced by macro liquidity. Hugan predicts that 2026 will be an up year compared to all other previous cycles, saying it is a bear market. And ARK Invest, Glassnode and others are saying like this. They say cycle still exists, but it is narrowed or compressed. They call this is a super cycle. In their prediction, they assume that we will see multi-year steady bull market with a shallow corrections. There should be only 20 to 30% of corrections instead of 80 to 90 or 70 to 90. Why? The institution adoption just created a floor. ETFs are now absorbing the selling pressure and governments are building the Bitcoin strategic reserves. Now Bitcoin is moving from a speculative asset to more of a reserve or portfolio kind of asset right now. What is my take is that it's only my take after reading couple of other infos and everything. The traditional 4-year cycle, the parabolic run and then a deep correction, that cycle will be already over, I guess. Now minor selling and retail FOMO will not influence the price of the Bitcoin, but it doesn't mean Bitcoin will not have any bottom. Those bottoms will be entirely depend upon the M2 money supply or Fed policies or some credit expansion or something. Now we will not see the 12-month spikes. Instead we will see a multi-year sustained spikes. Now Bitcoin is moving from crypto native asset to more of a macro liquidity asset right now. There will be new cycle, but we can only watch how it is configured in the upcoming years. But one thing is sure, the new cycle will not depend more on the halving side. They're mainly on global monetary policy. So what this means for Bitcoin investors? Implication 1, don't fight Fed. Currently Bitcoin is morely dependent on the global macro liquidity. Now you need to look into the central bank policies other than halving cycles. When Fed is easing and M2 money supply is increasing or cutting rates, then Bitcoin will goes up. When Fed is tightening or there is a quantitative tightening for a long period, then Bitcoin goes down. So the monetary policies will be the main drivers. Implication 2, the volatility will be very lower. Now we won't see the 80% crashes that happened in last cycles or something. Now ETFs may create that stabilization for the big crashes. But 3 to 40% of the correction still can happen because of the risk of period of the institutions and all the Q1, Q2 money supply demands or congestion. Implication 3, the horizon extended. The old playbook like the bear market and the post-halving parabolic run to 12 to 18 months, that thing is already over. Now it will likely as a stock right now allocate as long-term portfolio and buy more while the corrections happens. Now Bitcoin hold will be 5 to 10 years instead of 10 to 12 months. Implication 4, halving still matters for narratives. Even though halving doesn't play much on the price action, it will drive new narratives. Whenever halving occurs, the media covers it. Institutional investors will look into the thesis or retail become more aware. Even though all this case, the 2028 halving is still matter. Not for the supply, but for attention and institutions revaluation triggers. Implication 5, watch institutional flows. In the previous cycle, we will say watch miners capitalization, that will be the bottom. But in this era, the ETF era, we will check the institutional flows right now. If ETFs are showing a sustained outflow for 4 to 6 weeks, that is a red flag. If there is a sustained inflow despite the price action is very strong, that means the accumulation is happening. The institutional advisors are now holding around 185k BTC. They are the most consistent holders. Wells Fargo, there are around $491 million worth of BTC. Morgan Stanley around 743 million, JP Morgan 346 million. Now Abu Dhabi Investment Council is considering Bitcoin as a store of value as like gold. On the summary, the bottom line is that the previous year's halving cycles from 2012 to 2021 is currently weakened right now. Maybe they are not going to be the primary driver of the price action of Bitcoin. 2025 will be the first post-halving year that end in negative returns, and RSI never went parabolic. Bitcoin peaked before halving, not after halving. Now institutional ETF inflow is overshadowing the miners' selling pressure. This doesn't mean Bitcoin doesn't even have a cycle. This means now the driver of the cycle will be monetary policies and macro liquidity. No supply shock or retail FOMO. For long-term investors, this is actually a bullish sign. It will be now more stable and less volatile. So the total addressable market is now expanded. So in this case, the volatility will be very less. Now the playbook is changed. Now we can't blindly follow the halving cycle. We need to watch the Fed, watching the macro liquidity and ETF flows. Coin is a macro asset right now. If this analysis helped you to understand the structural shift in the Bitcoin in the last year, subscribe right now. We will be posting more content related to this topic and macro aspects of Bitcoin. We are not talking about the hype-driven tokens or anything like. We are mainly focused on the macro aspects. In the future, maybe some trading aspects as well. Thank you for watching. See you in the next video.